Hello, everybody, and welcome to our Making Sense of the Market webcast. It's October 16th, 2024. We're going to give it another minute or two to let other attendees join, then we'll get started here in just a minute. So please stand by. Okay, we're about 1 minute past the hour, so we'll go ahead and get started. Welcome again to our Making Sense of the Market webcast. I am your host, Scott Duba, Chief Investment Officer at Prime Financial. I'm joined by my two colleagues, Will McGuff, our Chief Investment Strategist, as well as Eric Kraus, one of our lead portfolio managers. And we're going to follow a similar cadence as we've done in past quarters. We're going to keep it conversational. The goal is really to just talk through some of the issues that are driving the macro on the markets over the past quarter and what we see up ahead. So before we get into that, just a quick refresher on who we are and what we do. If you're not a client or you're new to the firm, Prime Capital Financial is a national wealth management, retirement plan, and institutional business. We have over 14,000 wealth management households, over 600 retirement plans, nearly 30 billion of AUM, and nearly 200 of advisors across the entire country. If you're new to the firm or would like to learn more, I'd encourage you to reach out to one of our advisors to learn how we might be able to help you. We, as in Eric, Will, and I, sit on the investment team, and we'll now kind of get into the heart of today's conversation. Starting off with the current headlines. So if we kind of zoom out, you've been reading the paper, as usual, there's cross currents. There's good things, there's bad things. On the business side, companies seem to be putting good profits up in Q2 and in Q3. We've obviously had a very favorable movement in Fed policy over the past 90 days, which has dominated the markets in a good way, that is. Finally cutting rates has really sort of been the lead story in Q3. We still have the persistent geopolitical threats on the horizon, whether in the Middle East, the Far East, or Russia. Simmering tensions abound as usual. And more broadly in the economy, you still have some question marks. We have some job cuts that are more targeted at this point in Boeing and some other firms. There's kind of a separation between those who are doing well and those who are not. But overall, economists seem reasonably optimistic about what's ahead. So as we kind of level set on the year to date, now that we're about 3/4 of the way through the year, I'll direct this question to Will. Will, 9 months in, how does the year to date compare to prior years?
Thanks, Scott, and thanks everybody for joining in and spending an hour of your day to listen to our update. So far this year, the S&P 500, which measures the largest 500 stocks in the US, is up over 20%. So it's been a really good year. We've got it highlighted on the far right of the chart here. And what you see is the calendar year returns, with obviously 2024 being a year-to-date, a partial year. So you can actually see visually how averages never really play out. It's either real up big, you see a lot of 20s and 30s, and also the drawdown for the year, which is the highest point to lowest point of the S&P's return price index per se, is the red dot on the bottom. So S&P is up 21% this year, and during the month of August, it was down 8% from peak to trough. So this kind of shows you that, you have to weather some volatility to get the returns, but also returns of this magnitude can go higher. So we are in a bull market, as you can see, up 24% last year, 21% this year. And we'll get into some of the reasoning as why, but it's going to take a big shift to change that, which we'll talk about as we go forward. But let's look at the other major asset class, which is bonds, on the next slide. And here we're showing you the same chart, but the Bloomberg US Aggregate Bond Index, which is basically the S&P 500 for bonds. It's the most well-known proxy for the fixed income markets. And as you can imagine, bonds are less volatile, so they're up, down, and up less and down more. So what you're seeing is a 4% year-to-date return for bonds after up 6%. But the big story here was 2022. Bonds were down 13%, stocks were down 2%. So it was a year where diversification did not work. And I would also use this chart to highlight the point that you can get yield, so interest from bonds, but you can also get capital appreciation. So we're seeing an environment this year where we're up 4%, about 3/4 the way through the year. So we're on pace, if rates continue to come in a little bit, to see bonds outpace the short-term rate. You know, Fed just reduced rates down to below 5%. So again, it highlights the importance of not parking your money in a money market fund, but also investing in fixed income where you can get yield plus capital appreciation. On the final slide for this year's update, or partial year update, is the asset class jelly bean chart. So what we've done here is highlighted all the asset classes by colors with their calendar year return. So you can see the importance of maintaining a well-diversified portfolio, which includes many, or if not all, of these asset classes, which is the white box in the middle. So some asset classes can be at the top or at the bottom. Large cap US stocks tend to stay at the top. They've driven this market higher. We all are aware of the Mag 7. But one to point out here is the second best asset class year to date is emerging markets. So this is China, Brazil, India, and Russia, up 17% compared to S&P, up over 20%. You'll see just in the last couple of years, emerging markets were down. They're at the bottom of the chart. So again, it's all about owning a balanced, well-diversified portfolio so that you can reduce volatility and have a smoother return with your investments. So that's the update for where we're at this year. I'll turn it back over to you, Scott.
Thank you, Will. Super helpful. Eric, I might direct this next one at you. On that prior jelly bean chart, you know, green is still winning, the large cap. Is that still the theme, or what else has been driving equity index returns year to date?
Well, it's a good question. I think if we look at this first slide that we've got here to describe things here, we look back at 2023, it was really a fine individual performance from Magnificent Seven. So the AI enablers, AI related stocks, semiconductors had fabulous performance in 2023, up 76% relative to the rest of the market, only up 8%. And it looked like there was going to be sort of a rerun this year. In the first half of the year, the S&P 500 had a really fabulous return, but it was driven by those AI stocks and those semiconductors. But we had, you know, somewhat under the surface. I know Will pointed out that 8% decline in the S&P 500 that we had to go through in August, but it was much more severe actually for the semiconductors and those NASDAQ names. But it's kind of shifted from an individual sport into more of a team sport here in the last quarter. Some of that's the Fed rate cutting cycle, which we'll talk about. But a lot of this comes down to profits and earnings growth. So for the last couple of years, earnings growth for the Magnificent Seven stocks has been fantastic. 31% in 2023, estimated to be 34% this year. But if you look at that chart on the top right-hand side, we see those green bars inevitably started to trend back lower to still a very great level in the high 20s, low 20s. But we're starting to see the rest of the market pick up a little bit. So some earnings from smaller companies, maybe from financials and industrials, some of those sectors of the market that have been on the sidelines here. So we view that as a good thing for diversified investors to see, you know, still a spread here on the year-to-date basis, the Mag 7 still outperforming, but a little bit more of a healthy participation from the rest of the market. As far as what else is driving the market outside of you know, kind of that Mag 7 and the little bit of rotation that we've seen, we're also seeing a little bit of multiple expansion. So if we look at the next slide here, we can kind of talk through and see you know, where multiples stand. We talk about multiples. What that really boils down to is how much are we paying per unit of earnings on the average stock in the S&P 500. And you know, we see these green dotted lines running across the page here. That top green dotted line would suggest kind of a overvalued market on a historical basis. And we can see that the market trading at 21 times forward earnings is a little bit expensive. So earnings have grown, but also people's willingness to pay up for those earnings has also grown. So that kind of leads me to the third factor, which has been driving markets, and that's sentiment. So sentiments ultimately have a lot to do with short-term performance in markets, less to do with the long-term performance. That's really driven by fundamentals. But sentiments, understandably, people are feeling a little bit more excited today than they were a couple of years ago related to the innovation in the stock market, the innovation behind AI, but also the relief. You kind of double that with the relief of interest rate cuts on the horizon, or we're actively undergoing interest rate cuts. So that's led investors to maybe get a little bit more on the greedy side, something we pay very close attention to. Obviously, we try to follow Warren Buffett's advice of being a little bit more cautious when others are greedy, and a little bit more greedy when others are fearful. So today where we sit, sometimes these runs of greed or enthusiasm don't necessarily mean we're going to crash immediately here, but it could give us a reason to say, hey, look, is it time to just make sure that things haven't gotten too far too fast before we kind of continue through the rest of the year. But overall, it's been a great year. Like I said, it's been very positive to see some broadening of that participation in the last couple of months. And I think there's plenty of room for some optimism over the long term ahead still, despite these maybe short-term overbought conditions.
Yeah, I think the point's well taken, Eric, that the sentiment might swing around on the short term and drive the short term performance, but over the long term, it's more the fundamentals that win out. That being said, there's certainly some macro impacts that are driving the short term. Will, I'll direct this one to you. Bring us up to speed on inflation and the Fed. How are both of those things trending?
Thanks, Scott. So the Fed's got two mandates, one of which is to keep stable prices, which they typically look at as inflation. We're showing you a very long-term chart here. It's the consumer price index year-over-year change, and it's from the mid-70s through last month. And essentially what you'll see here is the rate of inflation, and then also the core CPI, which takes out some of the elements, so more like food and shelter and stuff. The long-term average is just over 3%, but we know the Fed has a goal of getting it under 2%. And for much of the 90s and the 2000s and the 2010s, we were under that 2% range, which gave them more flexibility in how they approach monetary policy. So after the supply shock with COVID stimulus, inflation went through the roof, the Fed had to react, so they raised rates. They've just started to lower rates, but inflation has come down. So they want to see some staying power in that the inflation issue is under control. And again, I'm cautioning you here, there's a lot of data on this chart because we're looking at, again, 75 to basically 2025, but rates have actually been trending down recently until the last couple of weeks. And you can squint your eyes and see the very end of this chart, you'll see that CPI and core CPI diverged. So CPI actually ticked up just the slightest with this last release where core CPI went down, and that's actually spooked the bond market. So that'll be something to look for. I know we're talking about Q3 here, but that'll be something that we might be talking about in Q4. But what is driving inflation underneath the components of it will be on the next slide, if you want to hop forward one. And here you'll really see how, what elements of inflation are driving the overall headline number. Energy is the one we all feel the most often. It's at the gas pump, filling your gas tank. It's actually under control. So in the heat of the worst inflation in the middle of 2022, 9.1% was mainly driven by energy. Now it's negative. If you look on the far right, you'll see energy and core goods are negative attributors to the overall inflation, but other things have come through that have been sticky. Insurance has stayed there, shelter has stayed high. And we don't want to steal the thunder from our political discussion, but it's a huge topic. If you have watched any TV these days, you're very well aware that both candidates are harping on inflation. And so how does the Fed control inflation is, again, getting back to their short-term rate. So we're going to look at a long-term chart on the next slide about the FOMC and the rate they set. So again, we're going back to the early 90s through now with some projections going forward. But you'll see the Fed is, I like to equate it to a super tanker in the ocean. Once they change their course of direction, they tend to stay on that course of direction for a very long time. And just since the last update, the Fed has reduced their short-term rate by 50 basis points to just under 5%, which shifted that course of action. And as you can see, all the projections off into the future are getting back towards their normal rate, which is the high 2% range. which we're not showing here, if you look at economic data, other central banks around the world, they've all normalized their rate back to that long-term average a lot quicker than the Fed has. So in a sense, the Fed's behind the curve versus their peers and what the economic data shows. But with regards to what the economic data shows, I'll toss that back to you, Scott, for the next section.
Thank you, Will. And Eric, I'm going to direct this one back to you. But I do want to keep count of our metaphor scorecard. So far, Will is in the lead with jelly beans and super tankers, and you've only tallied team sports versus individual sports. So keep that in mind as you answer this next question, Eric.
That's great.
What's driving the macro strength, and what exactly is the Fed watching?
Well, as Will mentioned, the Fed has these dual mandates to control inflation, to control prices, well, not control prices, but to try to keep them from getting out of control, and to keep the labor market healthy. And what we're seeing here, this is what's caught their attention, what caused them to make that maybe somewhat alarming in some people's eyes, 50 basis point rate cut, aggressive out of the gate, because as Will mentioned, maybe they thought they were behind the curve a little bit. Because we're starting to see some weakness in labor markets, both when we look at new job growth, which we'll cover in just a moment. But here, I think this is a great illustration on the left-hand side when we look at job openings. For a couple of years, we'd talk to our clients and did any type of hiring across, across the country. And what we saw was there were way more job openings than there were people looking for work. So it was an extremely competitive labor market. And what we've seen just in the last couple of months is those job openings have come back down. At the same time, the quit rate, meaning people just leaving their jobs and seeking something better, maybe getting a big raise to go down the street, has also declined significantly. But the positive here is though, Scott mentioned there were a couple of maybe key companies, Boeing, some banks, some other institutions that are trying to maybe lean up a little bit. We haven't seen a substantial amount of layoffs just yet. So maybe some early warning signs, but no severe cracks in the foundation, if you will, at this point. If we look forward one more slide here, we can look at the labor supply side of things. As I mentioned, we've kind of seen this steady decline in new job growth, and maybe some concerns even in reaction to the most recent labor reports about where that job growth is occurring, if it's occurring within government and healthcare versus other industries. Is that as healthy as what we've experienced maybe in past quarters or past years? And then the other thing we always talk about is labor force participation rate. So we're still not back up to the same participation rate that we had prior to COVID. But on the positive side, that age group 18 to 64, that blue line at the bottom right-hand corner of our chart here, we are actually above those pre-pandemic levels in labor force participation for people in that kind of prime working age, 18 to 64. So this has definitely got the Fed's attention here. The headline unemployment rate on the next page is kind of creeping around that 4% level. Very close to historical averages. They also watch the wage growth rate. So that wage growth, again, right in line with the historical average of 3.9%. And it's hard to kind of put this into practice and for people to feel this way, but for the last couple of quarters at least, wage growth has actually exceeded the rate of inflation. So we still have a lot of work to do for people to feel good about that. When inflation was up 8 or 9% and wage growth was only 5 or 6, people were losing real purchasing power. But if we're in an environment, as Will referenced, with inflation going back under 3%, trending towards 2%, and we still have wage growth at 4%, that's really what's allowing the consumer to keep spending here. That's what's allowed things to kind of keep rolling forward in the economic growth cycle. Last thing I would close with here, just on the health of the consumer, we're starting to see just a small uptick in consumer savings rate. And then the consumer finances, you can leave it there, Scott, that's fine. The things that are still kind of on our radar screen are the flows into early delinquencies on auto loans and credit cards, as well as the household debt service ratio. The one thing that I would suggest here with the falling interest rates can help with, there's the obvious thing that maybe a new rate on a car or a credit card might go down. Maybe someone's household debt service ratio will go down if they're paying less in interest. But there's also the possibility of unlocking some home equity for a lot of consumers that have felt maybe it was off limits to touch some home equity at an 8.5%, 9% HELOC. But as those interest rates come back down, I think you might see a flurry of refinancing of some of these auto loans and credit cards that are starting to plague people a little bit for those that are fortunate to have some equity in their home and potentially some better access to capital here as we do see those rates trend lower in the next 6 to 12 months.
So Eric, I think this last slide probably encapsulates, I guess, my take from what you went through. I mean, the economist forecasts, take them for what you're worth, take them for what you think they're worth, but only 1 in 3 is really predicting recession over the next 12 months. Eric, you can agree or disagree with this, but it would seem that if you look at the rate of change in hiring and job losses, it's negative, but the employment rate's only at 4%, which is just back to normal. And when you combine that with the stimulative or I guess less constrictive effects of lower interest rates, it seems like we're in a decent spot. Would you agree with that, or would you make any other views to kind of encapsulate the labor market view?
No, I think if I could end with a metaphor, I think the Fed's been up on this balance beam for the last couple of years, trying to balance the needs of inflation and the job market. And we're all hoping that they're able to stick the landing, the soft landing here that they've been talking about. And you don't want to speak too soon on that or jinx it, if you will. But it sure looks like the plan has been executed fairly well, because we do still have a very resilient economy, a very resilient stock market, and the Fed is able to start cutting rates at this point with inflation somewhat more under control. So we'll see if that can spike back up. A lot of factors could cause that to become in question, but as of right now, we'll go with the sticking the landing is the current view.
Okay, I like it. Way to pull out the save there with the visual image of Jay Powell on an Olympic balance beam. All right, let's move into kind of the more topical thing to gear everybody up for the Thanksgiving season, which is coming right on the heels of a presidential election, which will make for very spirited conversations over turkey and gravy. Will, let me shoot this one back to you. I think you've done some analysis, some study on kind of what the markets and what kind of the prediction markets are suggesting for the election. What are we thinking in terms of what impacts that'll have on the markets, on policy, on the macro?
Yeah, it's fascinating with the proliferation of online gaming and gambling and being legal in a lot of states now that you can actually bet on this type of thing with the U.S. election. So these are actually odds where there's money on both sides. You have investors, throwing their bottom dollar down on Trump right now, and he's actually shot up probably 4 or 5% in the last, call it 10 days, which is, you kind of have to follow sentiment. That's how trends, and from an investment standpoint, you want to follow where money is flowing because that tends to attract higher prices. So if you're listening to just the markets and the sentiment out there with how individual folks are out there betting their money on who's going to win, right now odds have tilted in favor of Trump and are also looking pretty bullish for the Senate. But then, again, Washington, D.C. is all about a balance of power. We have multiple houses, different there. And so you're going to see potentially the House lean Democrat here with regards to what the election market odds are doing right now.
Okay. This is interesting. I mean, whether you think it's good or bad that we're betting on elections, it's certainly topical, and it certainly gives us a window into what people are actually thinking, because you wouldn't be betting what you're thinking. Now, maybe move it over to the side.
For sure, within the polls, where you're.
Sorry, it seems like it's a bit of a toss-up. Fiscal policy-wise, is it, maybe compare and contrast if the Republicans win the White House, what that looks like, and what might it look like if the Democrats win?
Yeah, so we've got a playbook with Trump because he's had a term before. So his tax cuts in 2017 boosted earnings across the board. Utilities were up 19%, consumer discretionary was up 14%, industrials were up 14% as well. So I think you have to follow that playbook. But as we've seen, he's kind of taken his playbook and added to it with no tax on overtime, tips, and Social Security benefits too. So that's just more money in the consumer's pockets. You have to balance that with, well, how are you going to pay for it, which could also have detriments as well. It's really kind of status quo, in my opinion, with the Democratic proposals here. Nothing new from what we've seen over the last couple of years. But neither party has, they're in campaign mode right now, so they're making a lot of promises they're probably not going to ever see fulfilled. And so neither party has really talked about the offsets that they're going to have with all their proposals, which will kind of be, the detail that we're going to have to get as we start to see more clarity on what their policy is going to look like once we're through the election season.
So maybe this slide is concerning. the spending on entitlement programs always kind of going up and to the left. Discretionary spending on interest still going higher. You know, for both of you, is anyone ever going to care about fiscal policy?
I sure hope so. I mean, I think that is the long-term concern we should have as investors, is the amount of debt that's being projected with either candidate, frankly, because as Will mentioned, we're in campaign mode here. So there's a lot of promises being made to a lot of different constituents on what benefits they may accrue under a different regime in place, but very little action on how to pay for some of those things. And it's not a popular topic to talk about raising taxes. I know, obviously President Trump used tariffs, and I think that's his game plan again here, is to use tariffs. We've got some slides on that to potentially pay for some things. If Harris were to win and you have a divided Congress, which would be the most likely outcome in a Harris presidency, that you would still have a split Congress, it'd be very difficult to pass some of those tax changes that would be required to maybe offset some of the spending measures that we put in place. So I think you're on deck for a little bit of political brinksmanship again, if you do have a split Congress, and some issues actually getting things accomplished there, which is painful, I think, as a citizen to watch the gridlock and things get shuffled around. But as a financial investor, sometimes a little bit of status quo and things not moving too far one direction or another can be healthy for markets. The only thing I would suggest on those Harris policies, if you did get, going back to that slide where we talked about the odds of a red wave or a blue wave, if you did get a blue wave, I think, even beyond financial markets, we'd want to talk about some of the personal financial planning, items that would be up for discussion, for tax rates on capital gains, tax rates on estates, and other items that might be worthy of some attention there. But as of right now, that looks like one of the lower possibilities here. So maybe we talk about trade policy. Well, I know you've spent some time on this, or Scott as well. You mentioned Harris kind of the status quo, but maybe talk about the impact of Trump's tariffs and some of the other things that he's proposed to maybe raise some revenue here.
Yeah, so both Trump and Harris have proposals to support domestic manufacturing. They're just going about it in completely different ways, because Harris is wanting to offer new tax credits for investments like steel, biotech, AI data center, semiconductors, where Trump is very public about tariffs, trying to onshore as much as possible to boost the manufacturing and domestic sectors and productions here to create jobs. So again, all very similar talk tracks and what they want to do, but just completely different ways of going about it. And both of those ways have consequences, and with regards to the wealth management aspect from an investment side, and as you just mentioned with the financial planning, where you're dealing with asset location and taxes and various planning aspects there. But from a pure investment standpoint, the one thing that I think would have the most impact with regards to Trump's proposals and for tariffs is how diversified is your portfolio with equities in the US and internationally. So when you invest internationally, you get two things. You get whatever the stocks you invest in do overseas, but you also have to translate that back to US dollars. So you've got two risks when you invest internationally: currency risk and then security risk, whereas when you are investing in only dollars here in the States, you don't have that currency risk. So it's going to be important to watch to see who wins, and ultimately make sure that your portfolios are correctly allocated with diversification either here in the States or some international exposure there.
So Eric, maybe pick up that thread. I mean, Will touched on international versus domestic diversification, but let's drill down kind of on the sector level. Are there, in this slide here, it kind of talks through tariff impacts specifically of a potential, Trump tariff regime, but maybe talk more generally about how you think about sector allocation in an election season, and whether or not diversification is good or bad, depending on if you can call where the election is going to break.
Yeah, I think diversification is always important, but particularly here, some of the things that the sectors that worked really well in 2016 after Trump was elected were financials, industrials, dividend paying stocks, small caps. And you can make the argument that you have the tail end of both the Fed cutting interest rates, which is typically good for those sectors, and Trump policy, which was good for those sectors in 2016. So that would be certainly some areas I'd want to have some exposure to in a diversified portfolio.
Eric, can you hear us?
portfolio if Trump did win the White House again this year. The areas that struggled a little bit, frankly, maybe in conductors, retaliation from a tariff perspective. So when Trump was in the White House before, he did impose tariffs, but it was also just sort of a bargaining chip that he used, a negotiation tool. So when you get those headlines, there could be buying opportunities that come through, but there could also be some sectors that maybe get that tit for tat, those retaliatory tariffs. Now you've got some of them on the screen here. I'm not sure if there's any that you wanted to highlight, but just kind of in summary again, financials, industrials, small caps under a Trump regime, probably more the same of what's been working well if we did have a Harris regime, would be my viewpoint on that.
Well, I don't know if you have anything to add there, but I thought this chart was relevant just about how markets tend to move on policy announcements. I mean, Will, what's your take? Should we be investing on the basis of policy predictions, or is this best left to diversification to sort out?
I'm going to say it's balderdash to be investing on short-term headline risk from Washington, D.C., just given how dysfunctional Washington, D.C. is. And this data here proves that the market tends to overreact to news out of Washington, D.C. And this is just keying in on some of the tariff headlines from the previous Trump regime, where you can see on the day that he announced various actions, the total was down 11%. 5 days later, it was cut in half. So again, you can't really react to headlines in general. As a long-term prudent investor, fundamental value is created by the earnings of the securities that we own and the economic value they create. And that's ultimately what we're trying to do as asset allocators.
Yeah, and I think this slide sums it up better than any other. It's fun, it's exciting, it's interesting to talk about how markets might perform under an upcoming, regime from one part to the other, but over the long term, it doesn't really matter. The U.S. economy is strong and vibrant and dynamic and tends to grow over the long term. And, even when you kind of drill into election years over the long term, it's a fairly consistent pattern. So Eric, I'm going to direct this last section to you. And again, just to point to the scorecard, Will has nosed ahead with the use of the term balderdash, which I literally have not heard used since probably the early 90s by my then 90-year-old grandmother. So please bring us home with final thoughts. And, it's late in the fourth quarter. If you want to pull ahead of Will, now's your time.
Eric may need to level up his internet connection, so.
You might have wanted a TKO.
Yeah.
He might have folded. Balderdash just scared him away. Assuming he can reconnect, he can chime in when necessary, but Will, why don't you take this one?
Yeah, so again, most of our clients that you guys that are listening in are either through 401k plans with our retirement group or individual clients of our financial advisors. And one of the questions that we work with our advisors and they work with you guys on is there ever a good time to invest? Because these markets always make all-time highs. And what this chart is trying to show you is that it's okay to invest if markets are at all-time highs, because the risk of timing the market to try and to choose the right entry point is more detrimental than beginning the process of allowing your money to compound over the long term, which goes to show you, if you look at the far right chart, the 5-year return of investing on any day versus investing at a new high, it actually works in your favor to buy strength, because strength begets strengths. And really, all-time highs require patient, prudent investment strategies, which is how we approach the markets. And again, don't be scared by markets being at an all-time high for a reason not to be invested.
I think that's well put, Will. I think the other point to make with respect to the current environment we're in is just the market return around cutting cycles. We've already seen some good performance after the first rate cuts, but this is consistent with the past, and it generally persists for more than a few quarters. On the left, you see S&P 500 returns around the start of Fed cutting cycles. You got 4 cutting cycles, 95, 19, 84, 89, where you had fairly consistent market performance after the first cut, being the dashed line. and a couple cycles where it wasn't so good. But on balance, 4-2 in terms of persistent better trends after. And then same thing on the right, the US 10-year from a bond perspective, consistently positive, which makes intuitive sense because of duration and the effects therein. And if we end just with our typical valuation monitor, the current valuations do look maybe a little bit stretched when you look at US large caps, US value, US growth. But on the treasury end of the curve with US core bonds, munis, you're still modestly less expensive than typical. And DM equities, EM equities, and small caps kind of round out the middle. So I know we beat this drum a lot, but it's worth repeating. If you stay diversified and you stay committed to your long-term strategic asset allocation plan, the market will do your work for you. So to end with, I want to thank everybody for tuning in and just point out 3 upcoming events, which I think are particularly relevant, especially if you have next generation investors or individuals that are just starting their careers. These are things that I certainly wish I had tuned into when I was in my 20s. 3 topics. One is Home Sweet Home, is renting or buying the better choice? That's on October 30th. On November 20th, I think this one's particularly interesting and I look forward to it. It's the link between mental health and your money. So that'll be an interesting conversation. And last one is December 18, understanding lifestyle inflation and tips for managing it. I think a particularly relevant conversation as we head into the new year on the back of what, at least through the first 9 months of the year, has been really strong market performance. So again, if you're interested, please tune in to each of these 3 events. And you can probably scan these QR codes on your screen with your phone to have sign-up information. And it's not on here, but we'll be back again in 3 months in early January with our kickoff call for 2025. So a big thanks again to Eric and Will. Gentlemen, thank you for tuning in. Eric, did you make it back?
I made it back. I missed, I guess Will got more metaphors than me. Apologize for the connection issues down here.
That's all right. We'll leave this this heavyweight fight unsettled till next time because you didn't get a chance to participate in the final round. Will, thank you once again. Always appreciate your insight.
Thank you all.
Thanks, Scott.
All right, we'll see everybody next time. Thank you and have a good day.